So welcome, good people. Welcome. This is an Introduction to Financial Accounting, ATD Level 1. And it's a paper that was sat for in April 2022. You're going to look at question 5. So Peter and Chanda are in partnership, sharing profit and losses in the ratio 3:2 respectively. And the total balance as on 30th September 2021 was as follows. So we have capital accounts, current accounts, sales, inventory, staff salaries, rent and rates, electricity and water, accounts receivable and payable, delivery expenses, drawings, equipment, and its accumulated depreciation, purchases, and bank balance. Closing inventory as at 30th September 2021 was valued at 20,000. Forget the zeros. During the financial year ended 30th September 2021, goods worth 1,500 were destroyed by fire. Insurance company accepted the claim amounting to 1,000. Remember, the zeros have been restricted, so ignore them. As at 30th September 2021, electricity paid in advance amounted to 250. The partnership agreement provided for the following. So annual salaries are there, interest on drawings, and interest on capital with the restricted zeros. Then Pete guaranteed Chanda that his total income from the partnership shall not be less than 9 million in any year. Depreciation is to be charged on equipment at the rate of 10% on reducing balance method, and we are required to prepare the statement of profit or loss, partners' current accounts, and statement of financial position for the year as at 30th September. So the first thing to do in such like a question, go back to the additional information again, read it and understand it. So we have closing stock. Closing stock has been affected here. So let's take note of the closing stock, which is here. Then during the financial year ended 30th September 2021, goods worth 1,500 were destroyed by fire. Insurance company accepted the claim amounting to 1 million. So goods worth 1,500 were destroyed by fire and insurance compensated up to 1 million. So we have a loss of 500,000. So we can just say loss of 500 because the zeros have been restricted. So loss of 500. And this has affected the goods. So possibly the closing stock will reduce by 500 shillings. So we'll reduce closing stock by 500 shillings. Alternatively, we could treat this as a loss, a normal loss to the business. And if it was just a normal loss, we could debit the P&L, and then maybe think of crediting the 1,000 from insurance. So since we are talking about the goods, I think the best treatment we have here is just to reduce the closing stock by 500 because we lost goods worth 1,500 and the insurance company compensated us to the extent of 1,000 shillings. So the loss is simply the 500 which you are going to charge to the closing stock. So the closing stock will reduce by 500. And what does that mean? That our closing stock figure now will be 19,500 as opposed to 20,000 which has been given here. So as of 30th September, electricity paid in advance amounted to 250. Yeah, this is just will reduce the bill by 250, which is for the following year, and then of course it will affect the current assets. Then this will affect the appropriation account for partners, yeah, and then depreciation. Yeah, so we don't have quite a lot. So let's go to the question very fast. Solution number 1. So we have Pete and Chanda partnership, Pete and Chanda partnership. And then we say income statement for the year ended, 30th September 2021, like that. So let's underline this, let's underline that, like that. Then as usual, let's have the 3 columns to make our work neat and presentable. So the 3 columns. Then we start with the sales. This is a direct question. There are no workings. So sales, we always start with the trading account. So sales is 95,000. Just pick it as it is. So sales 95,000. Then we less cost of sales. Cost of sales is opening stock plus purchases minus closing stock. So let's get the opening stock from the question. Opening stock, you can see 1st October 2020, 15,000. So just pick it as it is. And since it's part of the cost of sales, we put it in the inner column. Then purchases we have 57,100. So check if we have any workings for purchases. Workings for purchases, carriage inwards, return outwards, they are not there. So purchases 57,100. Purchases 57,100. And then we less the closing stock. Remember, we've already done our closing stock. The closing stock was 20,000 minus the 500 loss on the goods. So we'll have closing stock of 19,500. So this will give us, I've shown the workings here, 20,000 minus this 500, 1 and 2, we have 19,500. So this will give us 15,000 plus 57,100 minus 19,500. That gives us 52,600. 52,600 like that. And because it's cost of sales, we less from the sales. That gives us 42,400. You need to check on your speed. That's why I'm trying to at least move with speed. So let's check if we have incomes and gains. Do you have any income and gain? Check income and gain. Income and gain. Go through the entire question. There's no any income. So we go to expenses directly. Expenses, and we start with staff salaries, 8,000. Staff salaries, 8,000. So go to expenses direct. Staff salaries. How much is that? 8,000. Do you have any workings? The only workings we have that affects here the P&L should be the electricity of 250 and depreciation. So let's pick all of them. Staff salary 8,000. Rent and rates 4,500. So just pick it as it is. Rent and rates 4,500. Next, go back to the question. Electricity and water 2,750. And remember, we have prepayment for electricity. So prepaid electricity is 250. So electricity and water is 2,750. Now put that in the innermost column. Then we less the prepaid electricity. This is electricity that belongs to next year. So we remove it so that we can have the electricity purely for this year, electricity charge purely for this year. Then we go to accounts receivable is not an expense. Delivery expenses 3,500. Delivery expenses 3,500. So delivery expenses 3,500 like that. Then next we have drawings is not an expense. Equipment, yeah, we have equipment. And equipment, there's something about equipment. The depreciations to be charged on equipment at the rate of 10% on reducing balance basis. So if it's 10% on reducing balance basis, we just take 10% of 60,000, which is the cost of the equipment, minus the accumulated depreciation so far, which is 6,000. So this will give us 5,400. 10% of 54,000 is 5,400. So just come here and say depreciation on equipment. Depreciation on equipment 5,400, like that, 5,400. And I don't think if we have anything else remaining. These are partnership stuff, yeah. So we don't have anything remaining. So we get the total. Let's get the total. This is 8,000 plus 4,500, that is 12,500 plus 2,500 plus 3,500 plus 5,400. That gives us 23,900. 23,900. I'm trying to go fast because I want to prove something here that you can do this question in the using very little time. So 18,500. So this is net profit. Net profit 18,500. So we go to the appropriation account, and the appropriation account, we start with anything that will add. Normally drawings, interest on drawings is pumped back into the business because it's the partners who pay the business for having withdrawn money from the business. So they pay the business. So interest on drawings, you have it here, Peter and Chanda, 150. So this will be an addition to the net profit. So we'll come here and say interest on drawings, Pete and Chanda, and the amounts are 100 and 150 respectively. So how much are you talking about? 250. So we have 250 like that. And then after that, anything that reduces, like we have annual salaries. Annual salaries, it means that it's the business that is paying them. So it reduces their net profit. So annual salaries, Pete and Chanda, 1,000 and 2,000 respectively. So we come here, annual salaries, Pete and Chanda, 1,000 and 2,000 respectively. This gives us 3,000. But because it's the business that is paying them, we less from this. Remember, interest on drawings, we said it's the partners who pay the business. So it will be an addition. Then it's the business that pays the annual salaries. Same thing applies to interest on capital. The partners have allowed the business their capital. So the business is supposed to pay the partners interest on the capital they have invested in the business. So interest on capital, Peter and Chanda, we have those figures. So this is from the business to the partners, interest on capital. So it will have the effect of reducing the net profit. Pete and Chanda, 3,300 and 2,200. This will give us 5,500 and we less. Do we have anything else remaining? So we are done with these three. We are done with that. We are done with that. We are done with that. Let's go back. Drawings. No, drawings doesn't feature in the appropriation account, but it will feature in the current accounts computation. Yeah, so current capital, those ones are not affected here. So then, if we don't have anything, we share the profit, the remaining amount in their profit loss sharing ratio. Trying to look for the profit loss sharing ratio that's here, 3:2. So we come back here. Let's get the difference. The difference is 18,500 plus 250 minus 3,000 minus 5,500. That gives us 10,250. 10,250. That is the amount that will remain after all these appropriation expenses and incomes have been considered. So 10,250 will be shared to these partners. This will be the profit on partnership, and they will share in the ratio 3/5 and 2/5. That's what we mean by 3:2. 3:2, add the 3 and 2, get 5. So 3/5 partner P, 2/5 partner C. So we'll take 10,250 divided by 5 times 3. That gives us 6,150. So partner P will take 6,150, leaving partner C with 4,100, which gives us 10,250. So 10,250 will be shared to the partners as profits. And at the end of the day, we will have nothing remaining because everything will have been shared as profit. Thank you. So that's how it is. We are already done with the appropriation account. That is profit and loss and appropriation account. So let's look at the next thing, partnership, partners current accounts. Partners current accounts. That was our question number 2. Let me see if I can draw this line clearly. Now these are partners current account. This is how we go about it. Draw the lines. Then of course we have the partner P and partner C, and this side also we have partner P and we have partner C. So we need to have, yeah, those columns. I think they have come out well. So we have partner P, partner C, partner P, partner C. This is the credit side, this is the debit side, and of course here we have the details, and here we also have the details. So that is the partners current accounts, part B of the question. This is part B of the question, partners current accounts. We always start with the current account balances. So current accounts balance, balance brought down. We have 3.5 and 4.5. So we'll come here and say balance brought down. We really don't need to have the dates. So 3.5 and 4.5. Then anything that increases on the business liability we credit. Anything that reduces on the business liability we debit. Anything that increases the partner's wealth we credit. Anything that reduces the partner's wealth we in the business we debit. So let's just start with this appropriation, because here we have quite a lot. No, let's go and start from here. Capital, we've already picked the balances. So we go drawings. I can see drawings. The rest don't apply. So drawings, Pete 4,000, Chanda 5,000. Drawings have the effect of reducing the wealth of the partners in the business. So it will be debited, and it also reduces the liability. So 4,000 and 5,000. I think I've captured the figures right. Pete and Chanda 4,000 and 5,000, good. Then after that, we go to this. So annual salaries. Annual salaries have the effect of increasing the partners' wealth in the business. So annual salaries 1,000 and 2,000. So we credit this because it increases annual salaries 1,000 and 2,000. Then let's just pick them from here. Interest on drawings. This is a charge by the business to the partner. So basically it's eating on the partner's wealth. So we debit. We debit because it's eating on the partner's wealth. Anything that increases partner's wealth, we credit. So this one is eating on their wealth, so we debit. So interest on drawings 100 and 150. Interest on drawings 100 and 150, like that. Then you go to the next one. Annual salaries, we are done with that. Interest on capital. Interest on capital, it is the business that is paying the partners for using their money. Remember, partners have invested their money in the business, so the business pays them. So interest on capital, it actually adds on the partner's wealth. So we are going to credit interest on capital. How much is that? This is 3,300 and 22, 3,300 and 2,200. Is there anything else? Yeah, we have profit on partnership. Profit on partnership. This is profit, so definitely it increases the partner's wealth. For partner P, 6,150. For partner C, 4,100. Yeah. So we are good, and I don't think if we have any other thing remaining. We have captured this, captured this, captured this. We've also captured this and the starting balances. So good, we are good to go. So let's get the total. Let's get the total. The total, simply draw those two lines, and the side with the highest figure will be used as the balancing figure. So like that, like that. Check on your speed. So 4,5 plus 4,2. I've added the 2 plus 4,100. That gives us 12,800. So 12,800. And this means that this side also will be 12,800 for C, partner C. And then for partner P, also get the side with the highest figure. 3,5 plus 1,000 plus 3,300. So that is 4,3 plus 6,150. That side looks like it has the highest figure. That's why I'm using it. So 13,950. And this side also 13,950. So the difference, which is definitely on this side, will be our balance carried down. So it will be 13,950 minus 4,100. That gives us 9,850. So we have 9,850 here. Then we have 12,800 minus 5,150. That gives us 7,650, like that. So good, we are done. That is the partner's current account, just like that. So we got the third part of it, and we will start with again the name. This is Pete and Chanda partnership. Pete and Chanda partnership. And then we say statement of financial position, statement of financial position as at 30th September 2021. Then of course we underline. Then as it is our norm, we have the 3 columns and we restrict also the zeros like that. So we have, we'll start always with the non-current assets, and I think we only have one non-current assets, which was the equipment. Yeah, run through. Is there any other non-current assets? Just the equipment. And the equipment cost is 60,000. Accumulated depreciation is 6,000, and depreciation for this year was 5,400. So the total cost will be 60,000 plus 11,400. 6,000 plus 5,400, which is the accumulated depreciation. So we'll have equipment here. Equipment. This is 60,000. Accumulated depreciation is 11,400, and with less, this will give us 48,600 as the net book value. So then, since it's the only one, we already have the figure there. There's no need to get the totals because it's the only one. We go straight to current assets. So let's pick current assets from the question. The first current asset we have from the question is sales, rent, electricity. Yeah, we had prepaid electricity of 250. It is here, prepaid electricity of 250. All the prepayments are assets because we paid in advance. So prepaid electricity 250. Then we go to the next one. Pick the next one. Accounts receivable 7350. Do you have any workings for accounts receivable? Check around, nothing. So accounts receivable 7350. Capture it as it is. Accounts receivable 7350. Accounts receivable 7350. Then we have closing stock. Closing stock, we had done some closing stock. The figure was, let's use this 19,500 because of the loss of 500. So closing stock 19,500. That's the figure that we used up there. Then check around if we have any other depreciation, interest, closing inventory, bank balance. Yeah, bank balance, accounts receivable. So bank balance is 4,000, and I think we are now done. Bank balance 4,000. Bank balance figure is 4,000. That's also an asset, the amount in the bank. So get the total. 250 plus 7350 plus 19,500 plus 4,000. This gives us 31,100. Then we go to current liabilities. And I remember current liabilities will have accounts payable and any other if we'll find. So accounts payable, let's see if we can also find any other current liabilities. So capital, current, sales, inventory, staff. Accounts payable is 7,200. Then let's check again. We've already captured accumulated depreciation. So this is about the partners depreciation. Okay. So accounts payable 7,200. And since it's the only one, there's no need of even pushing it, having it in the inner column. We'll just push it to the outermost column. So this was 31,100. So let's get the total. In fact, the total is our net capital employed. Net capital employed. So net capital employed, we get, which is current and non-current asset plus current assets minus current liability. So 48,600 plus 31,100 minus 7,200. That gives us 72,500. 72,500, like that. So that becomes our net capital employed. Then you say financed by. Financed by. So financed by, we simply have the capital accounts, and under the capital accounts, you have partner P and partner S. So partner P capital account was 33,000. Partner C 22,000. So 33,000 and 22,000 come here. Sorry, this is partner C, not S. So 33,000 and 22,000, and we get this. The total is 55,000. Then of course now we come to the current accounts. The current accounts also have partner P and partner C. Partner P and partner C, just pick these figures from the current accounts. So partner P 9850, partner P 9850, and partner C how much? Partner C 7650. So 7650. This will give us 9850 plus 7650. That gives us 17,500. 17,500. Is there anything that you are leaving? I doubt, because we've already factored in the net profits, we've factored in the drawings. Are there any long-term liabilities? We don't have debentures, we don't have long-term liabilities, so I guess we are done. So let's just come here and get the total. What is the total? This is 72,500. Good. It's already balanced. So this is our net capital employed. Net capital employed. So just like that, the equation is balanced. 72,500, 72,500. That is the end of it. They wanted question 1. We come up with the statement of profit and loss. There we go. 2 partners current accounts, and 3 this is our number 2 partners current accounts, and this is our number 3, a statement showing the financial position of the business as at 30th September 2021, and it has duly balanced. So that's how we go about it. This question I wanted to test on the speed, and you can see we've used 27 minutes. So that is the actual time that you're supposed to use to do this question, even in an exam. If you thought my speed was quite high, then you could be wrong. That is the speed, that should be the momentum that you should go with, and the question should still balance at the end of the day. So thank you, and welcome. You can share and subscribe for more.